Welcome back to this special edition of Editor's Roundtable. Well, after the rise came the fall today. While the Nifty held on to that 20,000 mark, we saw a sharp correction in the mid and the small cap universe. Now, the question is, should one be optimistic from here on or turn a bit cautious? So we've compiled all the opinion that we've got over the last 48 hours, which includes today after the 20,000 mark was hit, and even yesterday as we were on our way to achieve that milestone, magical number of 20,000. So let me start with the bullish view that we got from Vikas Jain of CLSA. He says that India has the most compelling earnings growth story over the next 2 years. India's expected earnings growth is likely to be the best amongst the 20 emerging markets. Valuations, according to him, favor a strong entry point in the Indian market. So very, very bullish from here on. Chris Wood, the famed author of Greed and Fear, he's written an article after the Asia Forum in Hong Kong, which took place earlier this week, and he's comparing India versus China. And he's saying that there is conviction among long-term investors that China is a structural underweight, while India is a structural overweight. But there is a possibility that just in the near term, China may outperform. But here comes the bit of a cautious view. Sanjay Mukim of JP Morgan is concerned about higher oil prices, lower rainfall. These are key macro concerns, and he says that tightening macro conditions support a reduction in beta in the Indian equity portfolios. So he's supporting a reduction in beta. And Rahul Chadha of Mirae Asset Global, we had a chat with him earlier today. He's saying the run-up in the mid and the small cap universe looks worrisome. He's already started booking profits in the mid-cap positions in real estate and hospitals. In fact, his call is that in the global equity markets in US, we are likely to see a pullback in the next 6 months. Now, moving on to the local voices that we heard. This is Sunil Singhania of Abacus Asset Management. He's optimistic, but he's laced it with a little bit of caution. He believes valuations are comfortable at the current levels. They're not unreasonable. We are trading at 18 times FY25 earnings, forward multiple, which is reasonable. But in the tilt between large caps and mid caps, he would put incremental money to work in large caps. And finally, Atul Suri of Marathon Trends PMS, he is emphatic about saying that we're nowhere near the bubble territory in the market. He sees more upside going ahead because on a 2-year basis, the Nifty has only risen about 15 to 16%. So there is no reason why we can't have another 8 to 10% rally. And even the small cap universe is just playing a catch up. If you compare it over the last 2 years, is underperformance. So that's just a quick compilation, a summary of what we've heard over the last 48 hours. On that note, let's listen into some opinion and then we'll wrap up this edition of Editor's Roundtable. Thank you for watching.
I feel where the market is heading or what my targets were, I see that there is still more upside going ahead. As I said, there's a lot of panic, there's a lot of talk of bubble, and there's a lot of talk of all that. I don't think we are anywhere near bubble territory. I think that there is more upside. And what I say is that you've seen 11% and you're like getting this thing, that we can have another 8, 10, 9, 10%, And a lot of people say that, oh, you want to sell out this segment, we should get out, blah, blah, blah. You never know. You could be missing a more interesting part in the market.
I think this move in mid-small caps, up nearly 35 to 40% since last 6 months, when globally Fed is tightening, balance sheet is contracting, would be a bit worrisome. So again, that's something we've been doing since, I would say, last 2-3 months. Look at our mid-cap portfolio, some of these mid-cap names, whether it's hospitals, real estate, or other sectors. Look, we've owned them for 5-7 years, but look, valuations look kind of fairly full here. So what we're doing is top slicing probably 10-15% and moving that to large caps.